The Walt Disney Company reported its latest quarterly figures before the market opened, alongside Novo Nordisk and Uber. We already touched on Uber. If you missed that, that would be in the top right corner. But looking at Disney stock, it's now down 1.1%. Not such a big deal. It was a pretty good quarter, in my opinion. Some good comments during the earnings call as well. As you can see, year on year, the stock is up 16%. It has a market cap of just over $202 billion, and currently the forward PE sits at 20.7 times. Now, me personally, I started buying Disney a couple of weeks ago. I started with a small position because I do think that as the streaming side of things becomes bigger and bigger and more profitable, I think this stock will be viewed as a good competitor to Netflix. Now, as we've compared this in the past, there is of course a difference between the Walt Disney Company and Netflix. Walt Disney has parks, has sports as well, so it does hurt them a little bit when it comes to free cash flow yield, for example. That's still much lower than Netflix. But the progress, in my opinion, is still quite good. So let's talk about that in this video. If you enjoy this type of videos, hit all the buttons. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So as always, we start off with a major overview by Consensus Gurus. As you can see, the quarter is quite clean. There are some small misses here. Entertainment missed by 1.2%. Free cash flow missed by 4.6%. And then when it comes to subscribers, ESPN Plus missed by 3.3%. But all in all, a very, very good quarter. I mean, EPS did beat by 22.2%, and that's up 44.3% year over year. And so zooming out a little bit and looking at the business segments, they break the business down in three segments: entertainment, which is this part right here, sports, which is a small one, and then experiences is the orange one. This is revenue. And then this is operating income. Of course, lots of operating income coming from the parks, but as you can see, entertainment is starting to pick back up. Looking at a couple of comments made by the CEO, which by the way will retire, I believe, in 2026. So it's going to be interesting to see who's the, heir to the throne of Disney. So Bob Iger said the following: "Our results this quarter demonstrate Disney's creative and financial strength as we advance these strategic initiatives set in motion over the past 2 years. In fiscal Q1, we saw outstanding box office performance from our studios, which had the top 3 movies of 2024. We further improved the profitability of our entertainment DTC streaming business. We took an important step to advance ESPN's digital strategy by adding an ESPN tile on Disney+, and our experience segment demonstrated its enduring appeal as we continue investing strategically across the globe. Overall, this quarter proved to be a strong start to the fiscal year, and we remain confident in our strategy for continued growth." So what happened this quarter? Revenue up 5%, income before taxes up 27%, total segment operating income up 31%, diluted earnings per share, as we've seen, up 35%, cash provided by operations up 47%, free cash flow is down 17%, but that's because of big investments when it comes to the parks segment, so that took a hit. Looking at the business segment, so we'll start with entertainment. Segment operating income increased $0.8 billion to $1.7 billion. DTC operating income increased $431 million to $293 million, and we've reached the following subscribers. DTC advertising revenue declined 2%, excluding Disney Plus Hotstar service. In India, DTC advertising revenue was up 16% versus Q1 2024. There was 178 million Disney Plus and Hulu subscriptions, an increase of 0.9 million versus Q4. That's quarter over quarter. 125 million Disney Plus subscribers, a decrease of 0.7 million versus Q4. By the way, this is their Q1 fiscal 25 quarter, just so you're aware. With regards to sports, segment operating income increased $350 million to $247 million. Experiences segment operating income of $3.1 billion compared to Q1 fiscal 2024, reflecting a 6 percentage points adverse impact year-over-year growth due to Hurricane Milton and Helene. That's around $120 million impact, and pre-opening expense of around $75 million impact in Q1 fiscal 25, driven by the launch of Disney Treasure. They also say that, it is quite successful at the moment. They also told us during the call that Disney Treasure is doing quite well already. Then looking at paid subscribers, all in all, Disney Plus did decrease 1%. In US and Canada, that did increase by 1%. As for Hulu, total Hulu increased 3%. Then if we look at the average monthly revenue per paid subscriber, we've seen an increase there. Of course, the increase is coming from, well, advertising, better advertising revenue, and an increase in prices. So of course, when you increase prices, you're going to get affected by churn, but they said that the churn was much less than what they personally expected. And so looking at guidance for the next quarter and then for fiscal 2025, they said the following: entertainment DTC, modest decline in Disney Plus subscribers compared to Q1, sports segment operating income adversely impacted by approximately $100 million due to college sports and one additional NFL game, and about $50 million from exiting the Venue Sports joint venture. As for experiences, Disney Cruise Line pre-opening expense of approximately $40 million. For the fiscal year 24, they expect high single-digit adjusted EPS growth compared to fiscal 24, approximately $15 billion in cash provided by operations, the entertainment side double-digit percentage segment operating income growth with an increase in entertainment DTC operating income of approximately $875 million, sports 13% segment operating income growth, experiences 6 to 8% segment operating income growth, and then the Disney Cruise Line pre-opening expense of around $200 million. Some of these figures were already given last quarter when they gave us, well, short-term guidance and then mid-term guidance as well, because remember, this was for fiscal 26 and fiscal 27, and since nothing has changed, I think these expectations are still quite good. With regards to the, well, comments that were mentioned during the earnings call, I wrote just 3 things that were interesting. So they're making ESPN available in any way the consumer wants it, through skinny bundles, for example. That's why Hulu Live and Fubo will improve the platform when that deal is completed. With regards to the flagship ESPN, that's going to include apparently betting, fantasy, and way more personalization. This will be released this fall, and it will also be available as a bundle item. They are very bullish on turning the streaming business into a growth business, and this is basically one of the main reasons why I opened a position in Disney, other than the fact that I do think that they are focusing more on quality content rather than quantity. And I think that the whole political saga around Disney did hurt them financially, and that's why they've been making some changes internally, and with the, well, releases of some ridiculous shows and movies that, well, should get cancelled or are already cancelled as well. But as I've shown you in my other videos, streaming is becoming bigger and more profitable. Netflix is showing the world that yes, a streaming business can be highly profitable. With Disney, we've also looked at the box office, and in the top 10, you can usually find a couple of Disney movies, and they're usually quite highly ranked. This year, we have a couple of Marvel movies that are coming out, actually quite big ones as well. Next year, we're going to have some big hitters. You have Avatar for this year, you have Fantastic Four, then you have Doctor Doom's movie, more Avenger movies, and I think those one will be again in the $1 billion when we look at box office, whenever that will be. So all in all, I am quite comfortable holding this position and growing it over time. Right now, looking at the stock, we can see that it did manage to rebound a little bit. Of course, things can change in the next couple of hours or days, but we can see that it did dip under the 20-day moving average during the day, but now we are a little bit above that. The 50-day moving average sits at $109.8, and the 200-day one sits a bit lower at $103. So all in all, I mean, a good quarter. I think today the market is just not in a good mood. Google down quite a lot, Uber down quite a lot. I mean, Snapchat, for example, was up 12-15% after hours. And then I think last time I checked, it was down 6-7% during the day. You have these types of days where the company reports quite a good report. Earnings call is fine as well. Maybe guidance is not as good as expected, or maybe there are some external factors that come into play, and then the stock market is like, you know what, doesn't matter, we'll take everything down. So that's about it for me in this earnings review with Disney. I'm still long, I'm still bullish on the company. Hopefully they will not disappoint me with some garbage content in the future. So that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye bye.